S&P 500, NASDAQ, Dow Jones. You hear these names all the time on the news, finance pages, everywhere. And whenever they move, people act like it means something huge. And the truth is, yup, it does. Because when people say the market is up or the market is crashing, most of the time they're not talking about just a singular stock. They're talking about indices. And if you don't understand what an index actually is, you're missing one of the most important pieces of the entire market. So in this video, I'm gonna tell you everything you need to know about indices. Let's get right to it. An index is basically a way of tracking the performance of a group of companies using a single number. Instead of looking at a single company on its own, like Apple, Microsoft, or Tesla, an index groups many companies together, and it shows you exactly how that whole basket performs. So for example, the S&P 500 tracks 500 of the largest publicly listed companies in the United States. That means when the S&P 500 rises, it's not just one company doing well. It means that, broadly speaking, a large part of corporate America is doing well. Or at the very least, the market believes it will. And this is where indices become powerful. Because if a stock tells you the story of one business, an index tells you the story of a much bigger system. It tells you how investors feel about the economy, about growth, and about risk. And of course, about the future. That's why indices matter so much. They're not just prices. They're a summary of market confidence. Looking at one company by itself can be a little misleading. But if you look at an index, especially a broad one like the S&P 500, you're no longer focused on one story. You're looking at hundreds of companies across multiple industries: tech, healthcare, finance, industrials, consumer goods, energy. Now you're seeing something much closer to the bigger picture. That is why an index is often one of the clearest ways to understand how money is flowing through an economy. If investors are confident, if they believe earnings will grow, if they believe the economy is stable or improving, they will buy. And when large amounts of money flow into major companies at once, the index rises. If they become fearful, recession concerns, high inflation, interest rates rising, geopolitical tension, money starts flowing out, and the index falls. So an index is not just measuring company performance, it's measuring collective belief. Now here's where most people misunderstand indices. They think indices move because companies are doing well or doing badly. That's only one part of the story. Indices actually move based on what investors think is going to happen next. This is one of the most important ideas in all of markets. Price is forward-looking. The market is always trying to price in the future before it arrives. So if investors believe the economy is about to improve, they start buying before the improvement fully shows up in the data. If they believe a recession is coming, they start selling before the recession is officially confirmed. That's why markets often move in ways that confuse a lot of beginners. You'll sometimes see bad news come out and the market goes up. Or good news comes out and the market still drops. Why? Because the market is not reacting to the headline alone. It's reacting to the difference between expectation and reality. Now let's talk about the different major indices. Because not all of them mean the same thing. The S&P 500 is probably the most important one overall. It's broad, it's diversified, and often seen as the benchmark for the United States stock market. If you want to know how the large cap US market is doing, this is usually where people will look first. The NASDAQ is more growth heavy and much more concentrated in tech and innovation names. So when people are more optimistic, willing to take risk, and excited about future growth, the NASDAQ often outperforms. But when interest rates rise and risk appetite disappears, it can also get hit much harder. The Dow Jones is older, simpler, and made up of 30 major companies. It still matters symbolically. But in modern markets, traders usually pay more attention to the S&P 500 and NASDAQ because they give a broader and more useful picture. So already, you can see that indices don't just tell you whether the stocks are up. They tell you what kind of market environment you're in. If the NASDAQ is ripping higher, that often tells you investors are comfortable with risk and chasing growth. If defensive sectors are outperforming and the broader market is struggling, that tells you people are more cautious. If the S&P 500 is breaking out while economic data is improving, that tells you confidence is broadening out. Now let's bring macro into this. Indices respond heavily to interest rates, inflation, employment data, GDP growth, central bank decisions, and geopolitics. Because all of those things affect how investors think businesses will perform in the future. This is why indices are so important for traders. They often set the tone for everything else. If indices are strong, The risk on mood can spill over into other areas of the market. Growth stocks perform better, sentiment improves, traders become more aggressive. So even if you don't trade the S&P 500 or NASDAQ directly, understanding them helps you understand the mood of the entire market. So if you take one thing away from this video, let it be this. An index is not just a number on a screen. It's a living reflection of an entire market, an entire economy, and the expectations people have about the future. And once you understand that, you don't just understand indices better. You understand the entire market better. And this is where everything starts to connect. Indices tell you the story of the bigger picture. Now that you understand how indices work, you've got a much clearer picture of how the overall market moves and how economy moves. But the next step is just as important. Not everything about the market is about companies or indices. In the next video, we're gonna shift into commodities, things like gold, oil, and silver. We'll break down how real-world events like inflation, supply, and geopolitical tensions directly impact the market. And once you understand that, you'll start to see how the markets connect in a much deeper way than you already do. I'll see you in the next one.